Why is $1 not equal to £1 or 1 yen? Have you ever wondered why you need a pocket full of yen just to buy a cup of coffee that costs $4 back home? It's because a currency is like a share in a company, and that company is the country itself. The value of a dollar or a pound depends on how much the rest of the world trusts that country's economy. Think of exchange rates as a giant global popularity contest happening 24 hours a day. When we talk about currency value, we're actually looking at a barometer for political stability and innovation. A country is like a magnet for capital. If interest rates there go up, or a groundbreaking new technology is developed, investors worldwide want a piece of the action. But to invest, they first have to buy the local currency. If a country sells a lot of products, maintains a stable government, and keeps inflation low, everyone wants their money. This high demand drives the price up. When you trade your dollars for pounds, you aren't just swapping paper. You are betting on the strength of one nation over another. You are essentially buying a stake in their future. Why can't we just print more money to end poverty? It sounds like the perfect solution. If everyone is broke, just turn on the printing presses and hand out million-dollar bills. But money isn't wealth. It's just a measuring stick for value. It's like a ruler. If you cut the inch marks on a ruler in half, the piece of wood you're measuring doesn't get any longer. You just need more marks to describe it. Imagine you are at an auction for the last loaf of bread on earth. If everyone has $10, the bread might sell for $10. But if the government prints money and gives everyone $1 million, the baker isn't going to keep the price at 10. He's going to raise it to $1 million. This is inflation. When you increase the supply of money without increasing the supply of stuff to buy, like houses, cars, or bread, each individual bill becomes less valuable. History is full of warnings here. In 1920s, Germany or modern-day Zimbabwe, people eventually needed wheelbarrows full of cash just to buy a single egg. It's a harsh reality check. You haven't made people richer. You've just made the numbers on the price tags bigger. How does money laundering actually work? You've seen it in the movies. Bags of cash being moved through back doors or hidden in offshore accounts. But at its core, money laundering is just the process of making dirty money, money earned from illegal activities, look clean so it can be used in the regular economy. Think of it like a literal laundry cycle. First, you have placement, where the dirty cash is snuck into a legitimate business, like a laundromat or a car wash, where it's hard to track individual customers. Next comes layering. This is the complex part where the money is moved through dozens of shell companies and international bank accounts until the original source is impossible to find. Finally, there's integration. The money comes back to the criminal as perfectly legal-looking profit from a business investment. It's a multi-billion-dollar game of hide-and-seek that governments spend huge resources trying to stop, because without a way to clean the cash, large-scale crime simply doesn't pay. How do banks actually make money? Most people think banks are just safe boxes where your money sits until you need it. In reality, a bank is a business that buys and sells money. When you deposit $1,000 into your savings account, the bank doesn't keep that cash in a vault with your name on it. They keep a tiny fraction, usually around 10%, and lend the rest out to someone else who wants to buy a house or start a business. The secret sauce is the spread. The bank pays you a tiny amount of interest for keeping your money there, say 1%, but they charge the borrower 7% for that same money. That 6% difference? That is where they make their billions. But they don't stop there. Banks also generate massive revenue through fees, overdraft fees, service charges, and credit card interest. It's a system built on the fact that not everyone will ask for their money back at the exact same time. As long as the community remains stable, the bank continues to act as the ultimate middleman of the economy. Why is every country in debt? And who do they actually owe? When we hear that the United States is trillions of dollars in debt, it sounds like the world is about to go bankrupt. But national debt doesn't work like your personal credit card. Most of that debt is actually owed to the country's own citizens. If you have a 401k, a life insurance policy, or a savings account, there's a good chance your money is sitting in government bonds. In a way, you are the banker for your own country. When you buy a government bond, you are lending money to the state. In return, they promise to pay you back with interest. Why do they do this? Because it allows a country to build roads, schools, and hospitals today, using tomorrow's growth. It's an investment in infrastructure that, in turn, generates more tax revenue down the road. As long as the economy grows faster than the interest on the debt, it's considered healthy. It's not a bill that ever needs to be paid off completely. It's a permanent engine that keeps the global economy moving. The housing crisis. Why can nobody afford a home anymore? This is the question that defines a generation. Why did your parents buy a house for 3 times their salary? Well, today, it costs 10 or 15 times yours. It's a perfect storm of 3 things. First, supply. In most major cities, we simply stopped building enough homes where people actually want to live. Between zoning laws and bureaucracy, new construction has stalled, while the population keeps flocking to urban hubs. Second, interest rates. For over a decade, borrowing money was incredibly cheap. This allowed people to bid higher and higher, driving prices into the stratosphere. And third, investment. Real estate is no longer just a place to live. It has become a safe haven for giant investment firms to park their cash. Today, you aren't just competing with other families for a starter home. You're competing with the algorithms of multi-billion-dollar hedge funds. When a house becomes a financial asset instead of a shelter, the average worker gets priced out of the neighborhood. Trading versus investing. What is the real difference? In the world of finance, these 2 words are often used interchangeably, but they are polar opposites. Trading is like high-speed gambling. You are trying to guess which way the wind will blow in the next hour, day, or week. Traders look for glitches or short-term patterns to make a quick buck. It's stressful, it's risky, and the vast majority of people lose money doing it because they are competing against supercomputers and pros who react in milliseconds. Investing, however, is like planting an oak tree. You are buying a piece of a business because you believe it will be more valuable in 10 years, not 10 minutes. An investor is a co-owner, not a speculator. Investors don't care about the daily noise of the stock market. They care about long-term growth and compound interest. One is a full-time job of chasing candles on a chart. The other is a patient strategy for building generational wealth. The trader wants to get rich today. The investor wants to ensure they are never poor tomorrow. How the rich use debt to get even richer. To most people, debt is a trap, a weight of interest payments that keeps them broke. But to the wealthy, debt is a tool. This is often called the buy, borrow, die strategy. Here is how it works. Instead of selling their stocks or real estate to buy a yacht or a new mansion, which would trigger a massive tax bill, rich people take out a loan against their assets. Because the interest on the loan is usually much lower than the taxes they would pay if they sold. They get the cash they need for a fraction of the cost. Meanwhile, their assets stay untouched and continue to compound in value. In this world, there is bad debt that consumes your future and good debt that accelerates it. By using the bank's money to fund their lifestyle, they keep their own wealth growing forever. Where does all the tax money actually go? We all see that chunk of money disappear from our paychecks every month, and it's easy to feel like it's just vanishing into a black hole. But taxes are essentially the subscription fee for living in a civilized society. Think of your country like a massive homeowners association. Your tax dollars pay for the amenities that no single person could afford on their own. The interstate highways, the legal system that protects your contracts, the military, and the emergency services that show up when you dial 911. But there's a deeper layer. Taxes are a tool for social stability. They fund the safety nets that keep society from falling into chaos during economic downturns. Governments also use tax breaks to encourage things they want more of, like home ownership, and high taxes on things they want less of. It's the price we pay to maintain the infrastructure that allows us to earn money in the first place. Taxes are effectively the operating system of civilization. Is digital gold real money? Bitcoin versus the dollar. If money is just a measuring stick for value, why do we need banks or governments at all? This is the question that birthed Bitcoin. Think of regular money, like the dollar or euro, as fiat currency. It has value because the government says it does, and we all agree to trust them. But crypto is different. It's like a global digital ledger that nobody owns and nobody can cheat. While the government can print more dollars, diluting your savings, there will only ever be 21 million bitcoins. Is it the future of finance? Or just a digital bubble? The answer depends on what you value more, the stability of a centuries-old institution or the math-based security of a decentralized network. We are currently living through the biggest experiment in the history of money, and for the first time, the bank is a line of code that never sleeps.